Did you delete the elevator? Hi, everyone.
Go live on Instagram.
How do I go live on Instagram? Oh, hit the button.
Yeah. 1, 2, 3.
Hi, everyone. Welcome to episode 3 of the series of lives that will happen every Friday at 12 p.m. We are actually late. We had technical difficulties where I recorded and didn't. It was, I don't even think we might have audio, but no video. My apologies. So we're an hour behind schedule. Okay. So in these lives, I talk about different strategies as a private lender, different strategies for investors. Typically like flippers, people looking to buy, renovate, and sell property, or the BRRRR method, buy, renovate, refinance, and repeat, or buy and hold investors. And we talk about also creative financing, subject to, or seller financing, hybrids, mortgage method. And I'm a member of sub two, and I respect Pace Mortgage tremendously and his community. And so I learned a lot from his community. Definitely could share a lot with a lot of the community that we have out there. So a little bit about myself. I'm a private lender, been private lending for over a decade now. We work with different buckets of capital. We have our own institutional and other investors. And this episode is very, very interesting. Actually, it's something that I've been modeling out. I've been test piloting it with some clients. We've closed a loan like this similar about a month ago, might have been 2 months ago, that we did something like this. We always get very creative, but this is one solution that I see a lot of investors need, right? What's the solution? Well, if you're a real estate flipper and you're worried about like how much money you have to come down out of pocket, and then from there, after you close, now you got to get the project started. You need money to get to the first draw. Every month you gotta, these are 12-month loans, and you gotta make monthly payments, right? And that's cash flow, right? Because when you're doing a flip, what happens is you don't have no cash flow until there's no cash flow, and you don't reap the benefit until you sell, unless you're vertically integrated, meaning that you do everything in-house. You have your own construction company. You are the GC. You're managing it, and you're paying yourself through the draws throughout the project. Then, yeah, I guess that could be your cash flow. And I know people. That's another strategy that we could talk about on here. How you could I forgot what you call it. I'm trying to think of the name. You kind of beef up the budget a little bit to include what you want to pay yourself and the monthly payments, interest payments. A lot of investors, assuming you don't go over, think about, because like when we make a loan, let's say institutional capital, we go up to, let's say 90% of the purchase price, we give you 100% construction, up to 70% of the after the repair value. As long as the budget is everything, the numbers work in those ratios, then you can increase your budget to factor in like to cover your pay, but we'll talk about that later. It's another strategy. This strategy, what we're talking about, is someone that, this could be for beginners or for experienced investors. This deal that we did about a month ago was local in New Jersey, right by my mom's house, Monmouth Junction, New Jersey. And this client, obviously out of pocket closing costs, the out of pocket cash to close was something that was a concern. Also, monthly interest payments. So what we do is we like to blend like institutional capital with private capital, meaning we're going to have two loans, right? And what we'll do is, for example, for this scenario, what we did was the client basically, let me go look at the numbers again. I like this project. It was $240 purchase price. We had a 20, let's say a 20 $5,000 or $20,000 renovation budget with an ARV around $320, I believe it was. So this actually fit perfectly for what I was looking for, because I like projects that are local. New Jersey, could be Pennsylvania, Florida, depends where we are for this. We can lend nationwide, but I'm talking about the creative stuff, the perks, the gap funding, right? And basically, the reason why this worked out, because for this client was so what we did was, it was very, very interesting. So for example, let me go to it real quick. So for example, her out of pocket cash to close was around 65,000. Let's say it's around 65,000. She had to come, and that would have been cash to close. With our perk, we're able to roll in interest payments into the loan, 6 months of interest payments, and closing costs into the loan. Her out of pocket was like about 30,000 rather than 65,000, and she has no monthly payments for 6 months. It's amazing, right? This allows her, right, to have peace of mind where she doesn't need to worry about cash flow. Because obviously cash flow is important. You need money to make payments, right? She don't need to worry about that. And she didn't need to worry about tying up, an extra 30 grand into this project, where it allows her to use that money to do more projects, right? Or maybe she, whatever it is, right? Everybody has expenses and whatnot, but these are most professional flippers that do this, they want to scale. So that's why this is advantageous to come to someone like us that could be creative. We're not box hunters. We like to do things outside the box. And I like to get creative and find solutions. So last week we touched on gap funding. Is this gap funding? Yes, in a way, but the way we structure it is you're not getting money at the closing table, meaning you're not getting additional proceeds where you could take that money and do whatever you want with it. No, what we're doing is we're basically giving you another loan and to cover your closing costs. So we're going to give you money to cover your closing costs. Actually, no, this client let me step back, had less than 30 grand out of pocket. I apologize. I made a mistake. We gave them like probably around 100 and something percent loan to cost, where their cash to close is 65,000. Actually, I think they had to come out of pocket maybe 15 grand, if I remember right. Because I remember at the last minute, they didn't have the cash to close themselves. So I had to readjust the loan to basically increase the loan amount to basically give them more money. So my mistake, they got 65,000. Cash close was 65,000. I think they had to come out of, I think I gave them, no, I'm pretty sure I gave them more money, where their cash to close was about 15,000, let's say, or something like that. Because I'm looking at an old sheet in front of me, but so that's what we did. They had $65,000 cash to close. We gave a second loan, rolled in 12 months of interest payments. Let's call it 14 grand, right, for 12 months. We rolled in, points, closing costs such as a processing fee, legal fee, appraisal, title insurance, property insurance, the 6 months interest reserves, all that, whatever settlement costs into the loan. And so this client said it had to come out of pocket 65,000, had to come out of pocket, let's say 15,000, and they have no monthly payments for 6 months. How cool was that? Right? Like, why would you not want to take that deal? The only reason why you wouldn't take that deal is because, number one, it's more expensive, right? If you have the cash, come to me, you're going to have a better terms with no perks, right? If you want to figure out your own scenario, how are you going to make payments or bring your own gap funders, it's fine. We're okay with that. We allow you to do that. we could help you structure those deals. But if you want us to provide the full package, all in-house service, it's more money. So the only reason why you wouldn't take the deal is because you want to save on cost because it is more expensive. But the client understands. Like I have clients like, Adam, we know you're more expensive, but we like your service because we understand it's reliable. We understand that, you offer amazing customer service. You're there to help me. You're there to help me scale. And, there's other things that we touched on in the last line where like we have 24-hour draws where we give you submit a draw request. We send you a link. You take pictures. We get the pictures back. We release the money the same day. We tell you 24 hours. Most of the time, it's the same day. So you keep the project going. You don't have to wait to get reimbursed. Like whatever it takes, like a week to get reimbursed, and it could take even more than a week if whatever things get. The inspector misses stuff. It's a whole other live that I'll talk about. So going back, anybody have questions on here? If you have a deal, by the way, that you want us to look at, or let's say you need a proof of funds, right? You go to our website, go to levinecapital.com, the homepage, hit learn more, or go to the top where it says private lending. And we have, it says submit loan scenario, right? Takes less than 5 minutes. It's our quick application. Actually, I prefer if you have a scenario to basically click on there, submit the details, it inputs into our system, and then our team will start underwriting it, right? And what I want you to do is, let's say you want some type of perk, you could hit whatever you want, hit on desired leverage 100%. That's fine, right? We'll look at the deal, and then what you do is you go back and as you move along, there's a place where you could actually elaborate. It says, I believe it says, tell us more about the project, whatever it is. And you're right. It's a single family fix and flip, blah, blah, blah. And I'm looking for closing costs to be covered, and I want no monthly payments for 6 months, whatever. You tell me whatever you want. I may not give you everything you want, and I'll let you know this is what I'm willing to do. But look, tell me what you want, and I'll try to see what I can do, right? And finagle numbers and whatever it takes. And before you know it, less than 5 minutes, it's into our system. And our team will begin working on it, and it helps us stay organized. Because if you submit an email, emails get lost, they take longer. In the system, I got eyes on there, and they're going to begin working on it, right? And let's say you need approval funds, right? We got a cool tool as well. The tool, it's automated. Just don't abuse it. Please don't abuse it. But you go on there, request approval funds, you plug the information, boom, you get approval funds within less than a minute. If you want to book a meeting to speak with myself or my other team members, you go to book a meeting, you hit my link, hit my calendar, boom, you get my calendar, and you book a meeting. A lot of times, I prefer, not trying to be disrespectful in a way that I'm too busy, but a lot of times, like, someone texts me or call me, hey, I want to talk, and I'm like, I got a million things going on, and maybe I call you when you're busy, and then you don't pick up the phone. Then we're going back and forth, trying to say, just the easiest thing is just book a meeting, 15 minutes. It could go longer, but it just says 15 minutes. It blocks it on my calendar, and then boom, I'm there. Sometimes, today I had a meeting at 1 p.m. I had to move it because of technical difficulties here. But sometimes we got to, obviously, life happens. You got to readjust things and whatnot. But usually, it works. So going back to this scenario, right? Regarding 97% loan to cost, right, on this type of scenario, we've done greater than 100% loan to cost, but it really depends upon the profitability of the deal, location, the sponsor, which is or another term for the borrower. I could go into another live giving different lingo and stuff, but for the purpose of this, I want to keep it on topic. So this deal was in Monmouth Junction, New Jersey, right by my mom's house. South Project, great demographic. We're talking about a condo. Purchase price is $240,000. We're talking about a renovation budget around $25,000. Lipstick, right? They should, and a resale value $330,000, around there, right? This house or condo will not last. It's in a high desirable area, low supply, high demand, affordable, right? in New Jersey, 300,000 condo in a great town, it's going to sell. Great school, it's going to sell fast. They should be in and out of this in less than 6 months. I like this deal. The borrower's a realtor. She has experience. So that was one thing too that I forgot to mention is she thought she wanted to get 90% loan to cost for the standard. And what happened was, so I'm very flexible, right? And she didn't qualify for that. She wanted the gap funding. And what I did was I accommodated, because in order to qualify for, let's say, 90% of the purchase price, 100% construction, up to 70% of the after repair value, and this is like standard with most lenders for standard loans, you need to have, let's say, 6 like deals, 6 similar deals that have been completed, 6 similar flips that have been completed, right? Or it could be something you bought, renovated, and held, or bought, renovated, refinance, or bought, renovated, sold. This particular client had a realtor license, I think about 4 deals done. They qualify for 85%. They wanted 90, and I was like, okay, you know what? This is actually our first chance. I was like, look, you seem like a good person. I like the location. And I was flexible. So I gave them an extra 5%, bring it up to 90. Plus time, I brought them over 100%. I'm pretty sure it was over 100. It might have been close to 100. I forget the exact ratio, but it was very, very close. Let's say 100% on the cost. Maybe might have been 97. I forget the exact number. And then we so the out of pocket was $65,000 cash to close. They had to come out of pocket only $15,000, right, with our perk, because with 85% loan to cost without a perk that we, I'm going to come up with a name for these type of loans. I haven't coming up with a name. We're just calling them perks right now, but I'm going to come up with a catchy name where you say, hey, I want this, boom. I haven't, that's later on. Right now we're still like experimenting with stuff, and but 65,000 they had to come out of pocket. They came for, assuming 85% loan to cost, we give them 15% of the purchase, we give them 100% construction up to 70% of the after repair value. With us, we combined 2 loans, institutional, private capital. They only had to come out of pocket $15,000, right? Now, with that second loan, we prepaid 6 months of interest, right, on the senior loan, right? So they had no interest payments there. We rolled in closing costs, right? Closing costs, origination fees, appraisal fees, processing fees, legal fees, title insurance, property insurance, whatever settlement costs. Package it all to the loan, even interest payments on the second loan. We package it all together. And that's really what, and now they come out of pocket with less money, and they don't have interest payments for 6 months. How cool is that, right? And going back, like I said, like it's more expensive, but they have less less stress, of less money out of pocket. They can scale up to do more deals, no interest payments. And yeah, anybody have questions? I see there's some people joining us, and maybe I can help out. So we got California Private Lenders on Instagram. We got Grace Fit, 114 Realty Holdings. So if you guys have questions, like every week we're doing these lives. This was actually a real scenario that we closed about a month ago. And that was like, so I try to come up with solutions. And yeah, this is, to me, is game changing, because a lot of flippers, they, cash flow is always an issue. I know flippers, they go out and they have other sources of income, right? Because eventually you're going to want to start flipping, and then you're going to buy rental properties to have income, right? Because when a flipping, there's no income. So flipping is a way to build your capital, and then eventually you're going to want to deploy capital to buy investment properties for income. But for this case, where this solution allows the client to scale up, to be able to take on more deals because they have less money out of pocket. They can use that money to buy other deals, and they have no payments for 6 months, which now cash flow for 6 months shouldn't be an issue, and they should be in and out of this in less than 6 months because it's a high demand, low supply area with a budgets in a town where properties just don't last. There's not enough supply. It is a highly desirable area, in a great town with a great demographic, great school. Yeah, South I like that town. I actually grew up a little bit worse. I went to elementary school there up until 4th grade. Then I went to North Brunswick middle school, then moved to Colts Neck. Yeah, so I kind of have a little and my mom lives over there, so I like that. So and it was to me it was a good deal. And actually I forgot to mention this deal was about to go to sheriff's sale. So the seller made a good decision to sell the property because they had some equity in there. Otherwise, if they let it go to the sheriff's sale because they want to get more, they get nothing. That's another topic we talk about, why it's better to maybe sell it if you have equity rather than letting it go. But there's other things you could do too besides that with creative finance, working with someone, because ultimately when you get to that point, you're destroying your credit, which that's something you don't want to do. So really, but we'll talk about, these are other things we could talk about later on of people that are distressed, and you got to know your options. If you don't know your options, then obviously you're going to be putting yourself in a position you don't want to be. But anybody have questions? Grace Fit, you have questions? No questions. Yeah, so I think I explained this. I hope I explained it pretty well. And do me a favor, just go in there. And so we have a new person. Hi. So thank you for joining. We're talking about, I'll go over this one more time. A scenario we closed about a month ago, where we work with different buckets of capital. We have our own capital, institutional, and we have other investors too that like to come in on deals. And we basically structured this deal where it was a deal that was local to me. I could drive to it in 15 minutes. Highly desirable town, condo, great demographic, great school, high demand, low supply area with a resale value in the 330s. New Jersey, it's going to sell fast. Central New Jersey, you're right by, right by the major highways. You got a lot of big box stores. This thing's going to sell quick, and you're right at a high school too. So it's going to sell quick. And that's why I like this flip. Small budget, 25,000, and purchase price 240, 25,000 reno. Resale value 330. The listing agent, the flipper is actually a realtor, which will save a commission as well. So what I did was exactly what the topic is. Her out of pocket was so originally. So if you're not familiar with the way these loans work, fix and flip loan, what does that do? It covers the purchase, renovation, and up to 70% of the after repair value. We could go to 75, but let's be conservative at 70. So in order to qualify for like a box loan or a standard fix and flip or a bridge loan that covers purchase and construction monies, the max you can go, let's say, is 90% loan to cost, meaning you put 10% down, lender gives you 90%. How do you qualify for that? You need to have at least 6 similar completed deals, 6 similar renovations, right? This client had a realtor's license and about 4 completed deals. They qualify for 85, 100, right? So 85, 100 means that they put down 15%, lender gives them 85% of the money, and we still give them 100% construction. So they told me they qualify for 9,100. They didn't, but I worked with them. So make a long story short, to go fast forward, their out-of-pocket estimated cash close would have been around 65,000 when with the first loan. The second loan, all they had to do, so I basically gave them a second loan in conjunction with the first loan, because we closed the first loan, we sell it off 2.5 years. Second loan we keep on our books, or we could probably sell that retail. We'll figure that out later on. And the second loan we rolled in 6 months interest payments, and we rolled in closing costs. What are some closing costs? You have interest. You have maybe 1 month interest reserve, but we prepaid interest, so they had no interest payments for 6 months. Appraisal, processing fees, origination fees, title insurance, property insurance, legal fee, whatever other settlement costs, and we rolled that into the second loan. So then their out of pocket was 15,000 rather than 65,000. How cool is that, right? That's amazing. And why wouldn't you take that deal? Because it's more expensive. That's the only reason why I wouldn't take it. Otherwise, but like I said, I have clients that don't mind paying more for service. And yeah, that's pretty much it. What I did, they had no interest payments for 6 months. They should, in theory, be in and out in 6 months or less than 6 months. With this thing should not be on the market very long. Pardon, I'm just looking at my other screen because this is where all my numbers are. And anybody have questions? I know we have some guests on here. Want to make sure I can address anybody's questions. All right. So yeah, that's pretty much it. And please do me a favor, smash the like button. I hope you share this video, and please, ask questions in the comments. Let me know anything I can help you out with. Maybe I didn't answer something in here. Maybe I went too fast, whatever it is. But yeah, that's kind of like the solution. Prepay 6 months, right? Making a Dutch loan, no payments for 6 months, and roll and closing costs with a second loan. That's it. Very simple, actually. And that we do that all in house. What I would tell you is, if you go to our application and Levine Capital, we have automated proof of funds. You can use that tool. Just use it. Don't abuse it. You want to book a meeting, you can hit request, book a call. You could, myself or other team members. You could also submit loan scenario, and that's where you're basically submit, and you're gonna ask for whatever it is. And also, we have promos. Keep in mind, promotions do not work with perks. We're not going to give a promo with a perk. You either take the promo, or the perk. Promo without the perk will be cheaper. We can have that conversation later, though. Anyway, I hope you enjoyed this, and we're doing a live every Friday at 12. This time it's at 1 because of technical difficulties. And I'm going to wrap up now, and I'll see you guys next week. Thank you, everybody. Bye now.
Did you remember this?
I got to end it. How do I end it?